If you received Social Security benefits at any time during 2025, the IRS now mandates you to establish whether any portion of those benefits qualifies as taxable income. And for approximately 12 million older Americans who submitted returns last year, the outcome took them entirely by surprise. The income level that activates this taxation has remained unchanged since 1993. Congress established it at $25,000 for an individual filer and $32,000 for married couples submitting jointly. That was 33 years ago. They never modified it for inflation, not even once. So, a benefit level that would have kept you comfortably beneath the threshold in 1993 now places millions of retired individuals above it. And most of them remain unaware until they receive correspondence from the IRS informing them they owe money they already used. Here is what you must understand right now before anything else. If your combined income, which the IRS determines by adding your adjusted gross income plus any non-taxable interest, plus 1/2 of your Social Security benefits, surpasses $25,000 as an individual filer or $32,000 as a married couple, the IRS can tax up to 85% of your Social Security. Not 85% of your total income, 85% of the Social Security payment you already believed was yours, free and clear. That is substantial money for someone receiving the current average retirement benefit of $1,976 per month. That converts to as much as $20,155 in a single year that the IRS considers taxable income. I am going to walk you through exactly how this calculation works, show you 3 real scenarios of older Americans who got blindsided, and then give you specific steps you can take before April 15th, 2026 to protect yourself. One of those steps involves a form that fewer than 9% of eligible older Americans file, and it can reduce or eliminate quarterly estimated tax payments you may not even realize you owe. My name is James Collins. I spent 28 years inside the federal tax system, the last 11 as a senior advisor. I am retired now. I am not selling tax preparation. I am not running for office. I have no reason to shade the truth in any direction. What I am going to share with you today is information that is publicly available, but scattered across IRS publications, SSA guidelines, and dense tax code sections that no normal person has time to read. I read them for nearly 3 decades. I saw what tripped people up. I saw which mistakes cost retirees the most. And I saw how the system made it almost impossible for the average person to figure this out on their own. Let me explain the mechanism, because once you understand how the IRS calculates this, you will see why so many older Americans walk straight into it without realizing what happened. The IRS uses something called provisional income to decide how much of your Social Security to tax. Before I continue, if what I just told you made you concerned, that is because it should. Most retirees are losing between $2,000 and $5,000 every single year to IRS rules they never knew existed. I spent 28 years inside the system watching it happen. That is exactly why I wrote the IRS Senior Loophole Bible, 23 legal exemptions and credits the IRS publishes but never explains to retirees. And right now, everyone who gets it also receives my personal IRS deadline calendar for 2026. Every date you need to know. 1-page free link in the description and first comment. Do not wait until April to find out what you missed. They do not call it that on most of their public forms. On Form 1040, you will see references to combined income or modified adjusted gross income. But inside the agency, the operating term is provisional income. And here is how it works. Take your adjusted gross income. That is line 11 on your 1040. Add back any tax-exempt interest, which is the interest from municipal bonds that your state and local governments told you was tax-free. Then, add exactly 1/2 of your total Social Security benefits for the year. The sum of those 3 numbers is your provisional income. If that number lands between $25,000 and $34,000 for an individual filer, the IRS taxes up to 50% of your Social Security. If it exceeds $34,000, they tax up to 85%. For joint filers, the brackets are $32,000 and $44,000. Those thresholds have not moved in over 3 decades. Think of it like a landlord who set your rent in 1993 and then added a clause buried in the lease that says the definition of rent expands automatically every year based on how much your paycheck grows. But the discount you get never increases. Well, your paycheck went up because of inflation, not because you got wealthier. But the landlord treats every dollar of that increase as proof you can afford to pay more. That is exactly what Congress did with Social Security taxation. The benefit amounts went up with cost of living adjustments. The tax thresholds did not. The gap between the two has been capturing more retirees every single year. In 2000, about 18% of Social Security recipients paid federal tax on their benefits. By 2024, that number crossed 56%. The Social Security Administration's own actuaries project it will reach 60% by the end of this decade. You did not get wealthier. The trap just got closer to your front door. Now here is where the current environment in March 2026 makes this even more urgent. The IRS announced expanded enforcement funding through the Inflation Reduction Act, resources that are still being deployed this fiscal year. The agency has increased its automated matching capacity, meaning the computers that compare what you reported on your 1040 to what the Social Security Administration reported on your SSA 1099 are faster and more thorough than they have ever been. If there is a discrepancy, even an innocent one, you will hear about it, not with a phone call. If you have ever received correspondence from the IRS and had no idea what to do, you need my second guide, IRS Audit Shield, the Senior's Survival Manual. It breaks down the 14 most common IRS letters older Americans receive, what each one actually means, and exactly what to do in the first 72 hours. Most people panic and make it worse. This guide tells you what to say, what to send, and what never to do. Grab it now at the link below, and it comes with a free bonus, my personal IRS call script, word for word, so you know exactly what to say when you call them. With a notice, CP 2000 notices, which propose changes to your return and add interest from the original due date, have increased by roughly 22% for returns involving Social Security income over the past 2 filing seasons. At the same time, the Social Security Administration itself has undergone significant staffing reductions. Field offices across the country are operating with fewer employees. Average wait times for phone assistance have climbed. If you need to request a corrected SSA 1099 or dispute an earnings record, the process takes longer than it did 2 years ago. You are dealing with a system that is demanding more compliance while offering less help. That is the reality on the ground right now. Let me show you what this looks like in real life, because numbers on a page feel abstract until you see them attached to a person. Margaret is 71 years old. She lives alone in a small ranch house outside of Columbus, Ohio. Her Social Security benefit after the 2026 cost of living adjustment is $2,048 per month, which gives her $24,576 for the year. She also has a small traditional IRA her late husband left her. She takes the required minimum distribution each year, which in 2025 came to $11,200. She earns about $600 a year in interest from a certificate of deposit at her local credit union. Margaret assumed she did not owe federal income tax. Her Social Security felt like her money coming back to her, not income. But here is what the IRS sees. Her adjusted gross income is $11,800 from the IRA distribution and the CD interest. Her tax-exempt interest is $0. Half of her Social Security is $12,288. Her provisional income is $24,088. That is just under the $25,000 threshold for individual filers. Margaret got lucky, said Barely. But next year, if her required minimum distribution increases because her IRA balance grew even modestly, or if interest rates on her CD edge up, she crosses the line. She goes from owing $0 federal tax on her Social Security to owing tax on up to 50% of it. Nobody from the IRS will call to warn her. Nobody from Social Security will send a heads-up letter. She will find out the following January when she does her taxes, or worse, 14 months later when a CP 2000 notice arrives with interest already added. Now meet Robert and Linda. They are 67 and 65. They live in a modest three-bedroom home in Greenville, South Carolina. Robert draws Social Security of $2,210 per month. Linda started her benefit early at 62 and receives $1,480. So together, their annual Social Security is $44,280. Robert also works part-time at a hardware store, earning about $9,000 a year. Linda has a small annuity that pays $3,600 annually. Their adjusted gross income is $12,600 from Robert's wages and Linda's annuity. Half their combined Social Security is $22,140. Their provisional income is $34,740. That exceeds the $32,000 threshold for joint filers. The IRS will tax up to 50% of their Social Security benefits. On a return this size, that generates roughly $1,900 in additional federal income tax. Robert and Linda did not budget for that, and they thought Social Security was not taxed. They were incorrect. And the $9,000 Robert earns bagging mulch and cutting keys at the hardware store is what pushed them over the line. He works that job to cover groceries. The tax it triggered nearly cancels out the benefit of working. One more. Gerald is 73. He lives in Tucson, Arizona. He is a retired letter carrier. He receives Social Security of $2,160 per month, a small federal pension of $840 per month, and takes a required minimum distribution from his thrift savings plan of $14,000 per year. His provisional income lands at $41,760. He is well above the $34,000 individual filer threshold. The IRS taxes 85% of his Social Security. That means over $22,000 of his Social Security is treated as taxable income on top of his pension and TSP distribution. Gerald owed over $3,800 last April. He did not have it. He set up an installment agreement with the IRS, which charges interest and a setup fee. The total cost of not knowing this rule will exceed $4,300 by the time he pays it off. Here is the question I want you to sit with. Have you calculated your own provisional income for the 2025 tax year you are filing right now? Have you added your adjusted gross income, your tax-exempt interest, and half of your Social Security? Do you know which side of the line you fall on? If you have not done that math, you are filing in the dark. Oh, that is not a criticism. That is a diagnosis. Now, let me tell you what they do not make easy to find. The IRS publishes a worksheet in the instructions for Form 1040, lines 6A and 6B. That worksheet walks you through the Social Security benefit taxation calculation. It is also covered in IRS Publication 915, titled Social Security and Equivalent Railroad Retirement Benefits. Publication 915 is 41 pages long. It contains the detailed rules, the thresholds, and the exceptions. It is free on irs.gov. Almost nobody reads it. Here is something buried in that publication that matters. If you are married and file separately, and you lived with your spouse at any point during the tax year, your threshold is not $32,000. It is zero. The IRS taxes up to 85% of your Social Security from the very first dollar of provisional income. This catches couples who file separately for strategic reasons, sometimes to manage income-based Medicare premium surcharge calculations, without realizing they just created a far worse tax outcome on their Social Security. The rule is in Publication 915, page 7. It is not hidden exactly, but it is not highlighted either. It sits in a paragraph that reads like every other paragraph on the page. There is another provision most older Americans never hear about. If you repaid Social Security benefits during the year, perhaps because you received an overpayment notice and sent money back, you may be able to reduce the taxable portion of your benefits. The IRS allows you to either take a deduction for the repayment in the current year or claim a credit based on the tax you paid in the earlier year, when you originally received the overpaid amount. You choose whichever method gives you the better result. This is outlined in Publication 915 under the section on repayments that exceed the benefits received. For older Americans who received and then repaid large overpayments, which has become more common as SSA processes retroactive adjustments, this can save several hundred or more, but you have to know to claim it. There is also the question of estimated tax payments. If you owe tax on your Social Security and you are not having taxes withheld from another source, the IRS expects you to pay quarterly estimated taxes using Form 1040-ES. The due dates for 2026 are April 15th, June 16th, September 15th, and January 15th of 2027. Miss those dates, and you face an underpayment penalty calculated on Form 2210. But here is what most people do not realize. You can avoid the penalty entirely by having federal income tax withheld directly from your Social Security check. You do this by filing Form W-4V, the voluntary withholding request, with the Social Security Administration. You can choose to have 7%, 10%, 12%, or 22% withheld. That withholding is treated by the IRS as if it were paid evenly throughout the year, even if you only started it in October. This means you can start withholding late in the year and still avoid the underpayment penalty for the entire year. That is a significant advantage that most retirees do not use because nobody tells them about it. Right now, you know something most people your age do not know. You understand how provisional income works. You know the thresholds have not changed since 1993. You know the IRS is matching your SSA 1099 to your return with more precision than ever. And you know there are tools available to manage this if you act before the deadlines pass. Let me give you the specific steps. Step 1. Get your SSA 1099 for the 2025 tax year. If you did not receive it in the mail by the end of January 2026, you can access it through your My Social Security account at ssa.gov. If you do not have an online account, you can call the Social Security Administration at 1-800-772-1213. Current hold times are averaging 40 to 50 minutes depending on the day. Call on a Wednesday or Thursday morning before 10 a.m. Eastern if possible. Those tend to have shorter wait times based on recent SSA phone traffic data. Step 2. Calculate your provisional income using the worksheet on page 34 of the instructions for Form 1040 or the worksheet in IRS Publication 915. You need 3 numbers: your adjusted gross income without Social Security, your tax-exempt interest, and half your total Social Security. Add them together. Compare the result to the thresholds. For individual filers, $25,000 and $34,000. For joint filers, $32,000 and $44,000. This tells you whether 0, 50, or 85% of your Social Security is taxable. Step 3. If you discover you owe tax on your Social Security and you are not currently having anything withheld, file Form W-4V with the Social Security Administration immediately. Choose a withholding rate that approximates your expected tax liability. 10% is a reasonable starting point for most retirees in this income range. Mail the completed form to your local Social Security office. You can find the address at ssa.gov by entering your zip code. Allow 4 to 6 weeks for processing. Once it takes effect, the IRS treats the withholding as spread evenly across the full tax year, which protects you from underpayment penalties. Step 4. If you are currently making quarterly estimated tax payments using Form 1040-ES and you want to simplify, switching to Social Security withholding via Form W-4V may eliminate the need for estimated payments entirely. This does not change the amount of tax you owe. It changes how and when you pay it, and it removes the risk of a penalty for late quarterly payments. Step 5. If you are married and currently filing separately, run the numbers both ways. File jointly and apply the $32,000 threshold with the 50 and 85% tiers. Then file separately and apply the 0 threshold with 85% taxation from the first dollar. In many cases, the joint filing produces dramatically lower total tax, even if it affects other calculations like income-related Medicare premium adjustments under IRMA. Speaking of IRMA, the income-related monthly adjustment amount for Medicare Part B is based on your modified adjusted gross income from 2 years prior. For 2026 premiums, Medicare uses your 2024 tax return. If your income was higher in 2024 due to a one-time event, you can request a new determination using Form SSA 44, the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. Qualifying events include retirement, death of a spouse, divorce, reduction in work hours, and certain other life changes. Filing this form can reduce your monthly Medicare Part B premium from a surcharged amount back toward the standard $185 per month for 2026. Step 6. If you received an overpayment notice from Social Security and you repaid benefits during 2025, keep every record. Your SSA 1099 should reflect the net benefits after repayment, but errors happen. If the form shows the gross amount without accounting for your repayment, you need a corrected SSA 1099. Contact SSA to request one. In the meantime, you can still file your return using the correct net amount and attach a written explanation. Document everything. Keep copies of the repayment checks, the notices, and the corrected form when it arrives. I want to be direct with you about something. I am not a lawyer. I am not a licensed tax preparer. I am not a financial advisor. I am a retired federal employee who spent 28 years inside the system that generates these rules. What I have told you today is based on current IRS publications, current Social Security Administration guidelines, and current law as it exists in March 2026. And I would tell my own sister everything I just told you. I would sit at her kitchen table with a calculator and a copy of Publication 915 and walk through every line. That is the spirit in which I am sharing this. You deserve to understand the rules that affect your money. You earned that money over 40 or 50 years of work. You should not lose a piece of it because a threshold set in 1993 was never updated, and nobody in Washington bothered to explain what that means for you today. Let me bring this back to where we started. The IRS requires you to determine whether your Social Security is taxable. The threshold has not moved in 33 years. The cost of living adjustment for 2026 was 2.5%, which pushed benefits higher and pushed more older Americans above the line. And the IRS is matching returns to SSA 1099s with more speed and accuracy than ever before. If you get this wrong, you will hear from them. Not quickly, not helpfully. You will hear from them months later with interest already running. But now you know. You know how provisional income works. You know the exact thresholds. You know about Form W-4V and how withholding from your Social Security check eliminates estimated tax penalties. You know about Publication 915 and where to find the worksheets. You know about Form SSA 44 for reducing Medicare surcharges after a life-changing event. You know the filing status consideration for married couples filing separately. You know more than most people in your situation, and that knowledge is protection. For those of you who want all of this organized in one place, with worksheets you can fill out at your kitchen table and step-by-step instructions written in the same plain language I use here, I put together a guide. It is called the USA Daily Alert, 7 IRS Rules Quietly Draining Your Retirement in 2026 and How to Respond. It covers the Social Security taxation formula with a fill-in-the-blank worksheet, the IRMA appeal process with a sample SSA 44 walkthrough, and the required minimum distribution rules that affect your provisional income more than most people realize. It is $27, and the link is in the description below this video. You gave me your time today. That is something I do not take lightly. You sat through the math, the examples, and the details because you care about protecting what you earned. That tells me more about your character than any tax form ever could. The system is not going to simplify itself for you, but you do not have to face it uninformed. You now have the facts, the forms, and the path forward. That is yours.